I'm going to jump right in and share my screen here and kind of show you what the heck is happening with the market right now. We're going to go right into rate and explain to you where we're at, what the average current interest rates are, and oh, hold on. Zoom is sending images. Can you guys hear me?
Yes.
Yes.
Can you guys hear me?
Now I can.
Okay, yeah, my Zoom quit on me. Gotta love the internet. So I apologize for that, but I'm going to jump right in to share my screen again. Going to show you where we're at with interest rates and get right into that. So right now, if you can see right here, can everyone see my screen with the mortgage-backed securities? Chrissy? Okay, perfect. So we're in this red range right now. So today we went up and down. We're bouncing in between the 200-day moving average and the 50-day moving average. So we're kind of stuck in the middle. We were up and then we're down. So we had a lot of movement today. So 31 basis points, that's about an eighth to a quarter in rate movement so far. But we're stuck right above this. So we're holding ground, but we're not going through this. If this pierces through this, we may lock because there's a lot of room to go down, but we're going to be carefully watching this to kind of see where that goes. The 10-year's up 13, but it's also, if you look, oh, it's actually pierced through this, so it may continue to go up until these next layers of resistance. So we may lose a little bit more today. So I'm based on when the rates came out, I may lock a few loans in today to secure the gains that we had. So we had the PCE, the personal consumption expenditure, that came out on that came out on Friday, and it showed inflation was lower than expected. So that's fantastic news. That means inflation is on its way down, which we know is good for mortgage rates. So we're going to be watching that carefully as we go through the week. But in a nutshell, what that has done for interest rates is here is the national mortgage interest rate trend and the current mortgage interest rate average on all the mortgage rates. And this is based on bankrate.com. So this takes into consideration everyone that is paying to advertise on Bankrate and where they are currently with no points. So this is a really good illustration of where they've been. They went down into on the 30-year fix. They were in the low sixes early in the year. They actually dipped into the fives if you paid points. And then we got above 7 again, and we kind of come back down, come up, and we're on the way down again, this little trend. So we're right around the 6s, 6.875. The 15-year fix is right around the 6.2, 10-year 6.33, 5-year ARM is just under 6. Typically, these have points associated with them on adjustable rate mortgages. That's about where we're at right now. So we're in that consistent range. We're ranging about a half in rate over a 3 to 4, 5 month period. That's pretty consistent as compared to what we saw last year. It was out of control. But I want to show you a little bit about what we're doing with these loan level pricing adjustments. So I want to show you in detail how this affects mortgage rates in real time. So on the left here, we see these new loan level adjustments that everyone's talking about. I get emails and text messages and social media messages all day long. Basically, these are the new loan level pricing adjustments that we have to abide by. Now, to be very, very clear, all loans that are delivered to Fannie Mae and Freddie Mac by today, so the loan is closed and delivered to them, they have to have these pricing adjustments in them. So most lenders have had these in our rate sheets since March. So it's not a brand new thing that's affecting right this second. It's already baked into the rates right now. So I want to make sure you guys understand that. Like if somebody came to the table yesterday and they wanted to lock in because they knew this is coming into effect May 1st, it's already in the rate sheet. So that, and for 2 months it has been, because by the time that loan's closed, packaged up, delivered, it has to have that in there. So just to make sure everyone was clear with that. On the right is a current rate sheet and kind of how the pricing works. So if you look at, let's just look at 6% right here. 6%. That has a payment of $26.98. That's irrelevant to this, but that is a 6.0 has a cost of 98.02. So you would have to pay 2 points to get that rate. So let's look at what that would have looked like on this scenario last, let's say like February this year, where you got 3/4 hit now for that. So this pricing would be 98.7. So instead of 2 point cost, this would only cost 1.2 points to get this rate. Let's look at this one right here. So 6.875 today. If you were to take away that 3/4, you would be all the way down here at 6.12. I'm sorry, like 6.5 instead of 6.875 in rate, because that's a 3/4 cost roughly in between this range to get that rate. So what that has basically done, this adjustment right here, this person in this category, instead of getting a rate of 6.5, they're now getting a rate of 6.875. So it's about a 3/8 to rate cost based on this. Now let's look at the alternative. If you were at 3% down, right? You didn't have as big down payment and you had good credit, you would get a credit now of 0.625. So instead of getting the rate of 6.625, where it would cost you that 0.625 right here, you're now getting that rate with no points. So it's better off for the people that have very little down, and it's worse off those that have between 15 and 20%, or 10 to 15 and 20% down. So 20 right here, 10% down, 5% down versus 25% down right here. This little section is the most expensive. So this is not to rate. This is to the price, which is this column right here. Remember, if it's 100, that means there's no points involved. So this rate right here today, 6.875, would be no points involved. But if you go to here, you get a lender credit of 0.186%. And this is of the loan amount, right? So if it's a $100,000 loan, 0.186 would be $186 credit, to keep it simple. And then as you go higher in rate, you get lender credits. This is how people do loans with no closing costs. They jack up the rate, give you a lender credit to pay for it. So if you were on a $500,000 loan, this is almost 1%. That would be $5,000 in closing costs roughly that the lender could pay with this rate here. So I wanted to open up the questions because this right here is getting a lot of backlash. There's a lot of news on it. It's frustrating. People don't know if it affects them. So a lot of people think if I have 20% down, it's going to really affect me. But if you have 20% down and you had a 660, it's actually a little cheaper for you. Instead of paying very expensive fees, you now have a little bit of a lender credit. So it's making it a little bit better. Now, let me just make sure people understand this. This doesn't mean that your rate is better if you have a lower credit score, because the adjustments that were here, this just means that it's an additional adjustment, are significant. So your rate's still much better if you're higher in credit score and down payment and 20% down with a higher credit score. It's still much better than some other people. It's just these are the new loan level adjustment differences. So there's a lot of misconceptions out here, and I saw people say, well, we're gonna make people spend money on their credit cards to make their credit scores go down to get a better rate. That doesn't happen. Okay. Let me show you another grid so you can kind of see what I'm talking about. Hold on one second while I open this here. This is an Excel spreadsheet that shows the difference of the cost of it. So as an example, this person right here, if you have a 660 credit score, the previous loan level adjustment is 2.75 points cost for this person to get a loan compared to this person up here, which is only a half cost. So this person with this credit score has to pay 2.2 points to get the same rate as this person up here. So now that's 0.625 better. So instead of 2.75 in points, it's 2.125 in points for this person to get the same rate as somebody up here. So there's only a 1.75 or 1 point something like that quote or difference in actual cost. So you're not going to get a better rate if you have a lower credit score. There's still these massive loan level adjustments that are out there. They're just improving these by this amount. Does that make sense? I hope that makes sense, because sometimes talking numbers can make you crazy. But these are the loan level adjustments that were before the change. These are the changes for the better and for the worse to these numbers. So you're still going to have a much worse rate if you have a lower credit score than if you had a higher credit score and the same down payment. So just want to make sure that's clear. Any questions on the loan level pricing adjustments that I just outlined? Here's the chat questions here. So high credit, low down payment is where it's at. Yes, that's still where it's at, but you're still going to get a much better rate if you have 20% down than this. So people are asking, well, what if I just put less down? Will my rate be better? No, the loan level adjustments are just better, but overall the rate will still be higher if you put 3% down or 5% down. Because again, here's the difference here. There was already a 3/4 or 1% hit for doing less down. Now you're saving a little bit on that. So, but there's still about a 1/4 hit. So now the rate is about the same for somebody with 30% down as it is with 5% down. So it's actually slightly, it's almost exactly the same as 20% down. Now, if you're doing 5% down. So there's not, you don't get any, there's no benefit to putting less down right now. Seller impersonation fraud. Oh yes, please join that. So rates are very confusing right now. Borrowers right now are very, very rate sensitive. So I've seen it a number of times where we are spending a lot of time with customers and giving them great advice, showing them where they're at, and then they're realizing, wow, my payments are higher than they were a year ago, or they're really sensitive to payment and they're shopping online like they've never shopped before. So I've seen people go to really, really bad mortgage companies and really pay the price. But keep in mind, if we can get a loan estimate from that lender that has a lower rate, because there are people that will always do it cheaper. I mean, you guys know that in real estate, there's people out there doing 1% listings. There's always somebody that will do it cheaper. So we do have something called Loan Estimate Compete, LE Compete, where if you have a loan estimate from another lender, we will match that. So we do not want to miss out on doing loans for people that are shopping, and we don't want them to go to somebody that doesn't know what they're talking about. So if you have somebody that's really shopping, then get that loan estimate, but don't let them go to somebody that doesn't know what they're talking about. John, you had a question. What's the point of these rate loan level adjustments? They wanted to make it so it wasn't as bad of an adjust, or the rate wasn't as bad for some of these people with the lower credit scores. Because think about this. If you had a 780 credit score, you would only have a 1/4 discount point adjustment to your rate or to the pricing of your loan with 20% down, compared to somebody with a 639 credit score. They would have to pay 3 discount points. So let's put that in math. If it's a $500,000 loan, you're looking at maybe, well, let's do 100 since it's really simple. A $250 charge versus a $3,000 charge. That's the discrepancy right before. Now that discrepancy is just less. So the costs were really low for high credit and really high for bad credit. This was the difference. Now it's like this. It's still better, but the people down here are now supplementing here, so they're not as bad. So if you want to look at like what the agenda is behind it, they're trying to even the playing field a little bit on conventional loans. And I think one of the reasons if you look at FHA, there's almost no rate price difference between somebody with a 640 credit score and somebody with a 740. So they're trying to compete a little bit with FHA. But again, FHA is still going to have much better rates for those people with the lower credit scores than the people in the higher. But don't forget, FHA has that 1.75% mortgage insurance premium that's rolled into the loan as an additional cost. So you have to look at that to see if it makes sense. But that's more of the details, the devil's in the details, so to speak, on these loan level adjustments. It's not to rate, it's to the pricing. And the higher credit score with higher down payment is still getting a better rate than somebody with less down and lower credit scores. It's just the gap in between on the costs has now come closer, if that makes sense. So I hope that was a good explanation of how that is working, so you guys can really see and know how to explain this to your customers. But if you have people that are freaking out, I have somebody that wanted to cancel over it, and I said, listen, it's not the end of the world. This isn't going away. But one thing that is coming that we all need to be aware of, there is another loan level adjustment coming in June. This is for debt to income ratios. So if you have a debt to income ratio of 43, that means 43% of your total debts, including the mortgage, you're up to 43% of your total income. That's debt to income ratio. As of June 1st, it is now going to be more expensive for you. There will be a loan level adjustment cost if you're over 43 debt to income ratio of 3/8 in price. So what that looks like, I'm going to share this again. So if you look at this chart right here, this is the new one for debt to income ratio. Oh, I'm sorry, it's over 40%. If you're greater than 40% debt to income ratio and you're putting 40% down and up and less, there will now be a 1/4 discount point or a 3/8 discount point cost because of your debt to income ratio. So here's something you have to think of. If you're at a 39.9 debt to income ratio and your taxes came in a little higher than you expected, now you're at a 41. Well, because of that, you're now paying 3/8 higher in cost for that mortgage. So this is a new one that's coming out. Some good news. If you are 3 to 4 units, it's a little bit cheaper now on 3 to 4 units. So that's good. The rates have come down on those. And 2 units have come down as well. So those are some new ones. But this one right here, this loan level adjustment for debt to income ratio is another additional cost that people are going to have on conventional loans. And that's coming out. That's going to be rolled out June 1st. As far as when it's going to be implemented with Fannie Mae on the loans they receive. So guess what? This is already baked in right now as well. But this may become something that's in the news as well. So you may want to be aware of that coming. So that's all I've got for us today on these loan level pricing adjustments. It is what it is, right? It's just a little bit more expensive now for mortgages, which we all hate, but will this affect our existing mortgages? Mortgages that are already closed? No. Those are closed, already delivered. Those will never be changed. These are only on mortgages that are new. So good question. So if you refinanced, you would replace this with the older mortgage with a new one, and these would be part of that. So good question, John. Any questions on where we're at with rates? This week is going to be a pretty mellow week. We want to hopefully break through to the other side of the 200-day moving average, which has been our nemesis, and hopefully get lower rates as we move forward. Inflation's on the way down, so just keep our fingers crossed, say a little prayer for mortgage rates through the summer, but they will be better towards the end of the year and into the end of the summer. So if you guys don't have any further questions, then enjoy your week. And if you have anyone that's confused on these loan level pricing adjustments, just send them my way. I'll be happy to walk them through it.
Hey, Sean,
Yes.
quick question. This might be dumb, but you keep calling them loan level price adjustments, and then you just use that same word for the debt to income ratio.
Yes.
So what other things are in what other like loan level price adjustment
Oh, good question.
charts are there?
Here's all of them. I'm going to share this with you. These are all of the loan level pricing adjustments that are part of our everyday mortgage world. So on the left-hand side, if you look at this column right here, these are the credit scores, and these are the costs for the different credit scores. So if you have a 620 credit score, you have to pay 3 points to get the same rate basically as somebody up here that's putting 40% down with a 780 credit score. It's 3 points. So on a $500,000 home, that's a $15,000 difference in fees. Down here, there's some special attributes. Alternative FICO. So if you don't have a credit score, condo, it's 3/4 price right here for condo over 25% down or less than 25% down. So if you ever wonder why condo rates are higher, here's an example right here. It's 3/4 discount point more expensive to get a condo than a single family residence in this price range or in this LTV. We have investment properties. Look, it's 4 points additional cost to get an investment property. Manufactured housing has adjustments. 2 units, 3 to 4 units has second home. Look at these second home adjustments. They're now almost the exact same as investment property. That's why second home rates are so bad. If you have a second mortgage, if you're doing a first and a second, there's adjustments for risk on that. And high balance, if you're in California and those places that have high balance conventional loans, there's adjustments for that. So these are all of the adjustments that go into when somebody say, what's your rate? And I say, I don't know. I need more info. This is why, because each one of these things has an impact on what their final rate will be. So if somebody just says, hey, what's your rate today, Sean? It's almost like saying, hey, Melissa, what's the cost of a condo today? It's like, I don't know. Where do you want to be? How many bedrooms do you want? It's the same type of a thing. So I literally get that question every day. What's your rate today? And I like to giggle and say 1%, because you can get a 1 month ARM and pay 5 points to buy down the margin. So it's 1% today. you could do that. And that is an option, but nobody would ever want that mortgage. So anyhow, make a long story short, these are all of them, and the changes to those are on the right. This is where they were. These are the changes to them. So that's it in a nutshell. Hope that explained everything, Melissa.
Yes, thank you. And I was just thinking that because, I'm not really familiar with the lingo, but because I did have clients, of course, even just last night call and complain or talk about that, and I didn't really know how to address it. But
Yeah.
I think if I just tell them like, oh, there's always been loan level price adjustments based on many things, and this is just a change to that one chart.
Exactly.
Does that make sense? Okay.
Yeah. So these are the changes are on the right-hand side of that. Essentially, if you've got a 660 or lower credit score, or 679 or lower credit score, the loan level adjustments are not as bad. It's still not better than somebody putting 20% down with a 780 credit score, but they're just not as bad. And the loan level adjustments for those people above are a little worse, but they still have better rates overall than somebody with a 680 credit score. So it is the better borrower subsidizing the other borrowers, if you want to really look at it, but it's not the end of the world. But yeah, that's exactly what it is. So you can get frustrated if you want. There's nothing we can do about it. But if you're in that mix of you put 15% down and you had a 720 credit score, yeah, the rate's 3/8 worse this last couple months than it was before. So it is what it is. Can't do really anything about it, but we just need to know how to explain it, and that they still have a better rate than somebody else with lower credit score and lower down payment. So I hope that helps. Any other questions on what's happening in mortgage world right now? Don't forget, guys, we have our monthly home buyer webinar this Friday, Cinco de Mayo, and it's at noon for anyone that's wants to learn the entire process, how to shop for a mortgage, how rates work, everything that has to do for first-time home buyers. It's phenomenal. You don't have to be a first-time home buyer to be on this. It's free. Again, it's monthlyhomebuyerwebinar.com. So you can send your buyers here. I'll put the link in here. Homebuyerwebinar.com.
Nice to meet you.
Sorry, monthlyhomebuyerwebinar.com. I just put it up there. Anyone can register for it. They have to put who their real estate agent is when they jump on that, but it's going to be a live webinar. It's completely anonymous. Nobody can see other people like they can on a Zoom call. It is just me on the screen. And if you want to do these on your own and do these with me, then by all means you can. And we can go through that together and do a co-hosted webinar for you and your customers. So it's something that if you're open to it, if you want to be in front of the camera, absolutely, let's do it. So mine by myself is going to be, again, this Friday at noon. Monthlyhomebuyerwebinar.com is where you register. All right, guys, well, enjoy your week and we will be in touch.
Thank you, Sean.
You're very welcome. Thank you, Angie, for everything.